Interest rates. Why are interest rates important? Interest rates have an effect on consumer spending. Higher interest rates will result in loans costing more to consumers. Therefore, the less they will be able to buy on credit. This is how interest rates affect inflation. If consumer spending goes down, there will be less demand for products and services. Interest rates also affect the housing market, since it will cause homebuyers to have to purchase homes on too highly leveraged of loans to be able to pay as interest rates rise. As interest rates rise, banks charge more for loans. More of a company's earnings then go to paying interest on their loans. Since businesses can invest their excess cash in interest-bearing accounts to make money, interest rates will affect the amount a company can earn. Interest rates are a rate at which money can be borrowed or lent over a given period of time. To put it simply, the interest rate is the price of using someone else's money. The interest rate that you earn, that you pay on your home mortgage, is the cost for using the money that was loaned to you by the bank. And the interest rate that is paid to you if you purchase a CD at a bank is the cost that a bank pays you for using your money that you put into their CD. These rates will vary, but they're always set based on supply and demand. Interest rates are typically quoted for different time periods and expressed in different forms. We're going to look at three different examples of how interest rates are expressed. One being the effective annual rate, or EAR, the annual percentage yield, or APY, and the annual percentage rate, or APR. Let's take a look at each of them closely and see how they're applied. You often see interest rates quoted as effective annual rate. This indicates the total amount of interest that will be earned at the end of 1 year. The effective annual rate total is a result of the compounding over a period of time. It's also called the effective interest rate, the effective rate, or the annual equivalent rate. Let's take an example of the effective annual rate. On $1,000 invested with an EAR of 6%. We take the principal of $1,000 multiplied by 1 plus the rate, which is equal to 1,000 times 1.06, gives you a total of $1,060. If we then compound it a second year, we'll see that that $1,060 becomes $1,123.60. Annual percentage yield, it's the effective annual rate of return taking into account the effect of compounding interest. The formula for figuring APY is 1 plus the rate times to the power of the number of months that the rate will be compounded minus 1. Let's take an example of a business savings account earning a rate of 0.05% monthly. Now, it's important for comparing monthly rates versus yearly rates, because at first glance, you would say that 0.5% at 12 months is equal to 6%. However, we have to use the APY formula, and we'll see that 0.5% interest paid monthly for 12 months is equal to 6.17%. Annual percentage rate is the amount of interest earned in 1 year without the effects of compounding. It's the most common way of quoting interest rates. It indicates the amount of simple interest that is earned in a year. And since APR does not factor in compounding interest, or the compounding component, it is usually less than the amount of actual interest that is earned in a year. Let's take a look at an example of APRs as it's applied to a savings account. And typically what you see is APR expressed like it is in this example, an account with 6% APR compounded monthly. When you see this, what you're really getting is 6% divided by 12 months, or 0.5% interest every month. APR is then used to calculate the actual interest rate earned for each compounding month. There are three forces that determine interest rates. The first is the Federal Reserve, who sets the Fed funds rate. This affects short-term and variable interest rates. This is the rate that banks charge each other for overnight loans to meet the Fed's reserve requirement. Banks will charge their best customers their prime rate, which is typically above the Fed funds rate, but a few points below the average variable interest rate. The second is investor demand in U.S. Treasury notes and bonds. This affects long-term and fixed interest rate. The third force is banking industry. They offer loans and mortgages that can change rates depending on businesses' needs. For example, a bank may raise rates on credit cards if you miss a payment. In summary, interest rates help control the flow of money in the economy. High interest rates can curb inflation and slow the economy. Low interest rates can stimulate the economy but lead to inflation. That's why it's important to know whether or not rates are increasing or decreasing. Interest rates have a direct impact on both business and personal finances, as rates will determine the cost of borrowing and the return on investments. Interest rates also have an impact on consumer spending, which can also affect a company's profitability. When it comes to interest rates, the most common ethical issue that comes to mind to me in the recent years is the recent increase in the number of microfinance companies who have come into the marketplace. These companies lend small loans to low-income customers. These customers often have poor credit scores and have a difficult time getting competitive loan rates. Oftentimes, these companies disguise real interest rates in their advertising, and customers will pay over 300% in interest, not including fees. Oftentimes, these loans are set up where it's impossible to pay off the balance. Customers are left with a monthly payment for what is essentially forever. To profit from those in need is unethical, to say the least. In Proverbs, we are told, "Whoever oppresses the poor shows contempt for their maker, but whoever is kind to the needy honors God." As Christ's disciples, we should all be mindful of helping those in need, in business and in our personal life. To establish a business that profits by oppressing those in need is not only bad business in my book, but it's an act against God Himself.